Most people think financial collapse looks like chaos. Banks shut down. Money becomes worthless. Everything breaks at once. But consider three moments in history. Weimar, Germany. Hyperinflation destroys the middle class. A pension earned over 40 years buys a single loaf of bread. Savings evaporate. Yet in that same crisis, certain industrialists with access to foreign currency emerge wealthier than before the collapse began. The continental currency crisis. American merchants holding paper notes that financed the revolution go bankrupt. The currency becomes worthless. But farmers with grain stores and productive land experience severe disruption without total ruin. 3rd century Rome. The denarius collapses from 95% silver to less than 5. Aristocrats holding coin reserves watch their wealth dissolve across decades. But landowners with estates that produce grain maintain their position through the entire monetary crisis. Same collapse, opposite outcomes. Not just different outcomes. Structurally opposite outcomes. This isn't about intelligence. It's not about foresight. It's not even about preparation in the conventional sense. There's something else determining who loses everything and who doesn't. Something architectural. Something most people never see because they're focused on the wrong part of the system. To understand financial collapse, you don't study the panic. You study the sequence. Which parts of the system break first? Which parts resist longest? And why they break in order, not all at once. The standard narrative of financial collapse is built for emotional impact. A bank run, currency worthless overnight, entire economies frozen in an instant. These images dominate because they're dramatic. They compress time. They make collapse feel like an event. But this is where most analysis goes wrong. Collapse is not an event, it's a sequence, a progression through different tiers of the system at different speeds, driven by different pressures affecting different positions in fundamentally different ways. This matters because wealth isn't destroyed when everything collapses. Wealth is destroyed when specific mechanisms within the system fail. And which mechanisms fail depends not on the severity of the crisis, but on their position within the architecture. Understanding this requires moving past the drama. It requires examining how financial systems are actually structured. A financial system isn't money. It's a hierarchy of interdependent mechanisms, each serving distinct functions, each vulnerable to different forms of stress. Currency sits at one tier, the unit that denominates activity, the medium of exchange. Above that, time-extended promises, bonds, pensions, insurance, savings, obligations denominated in currency, stretched across years or decades, then institutions, banks, brokerages, clearinghouses, intermediaries connecting those with resources to those who need them. Underneath, or perhaps supporting all of this, the real economy, production itself, factories, farms, infrastructure, the creation of tangible goods, and at the foundation, political authority, the institutional framework that issues currency, enforces contracts, maintains order, grants legitimacy. These tiers are connected, but they are not the same mechanism, and critically, they do not fail simultaneously. When a financial system comes under extreme stress, these tiers respond in a specific order. That order is observable, it recurs, and it explains why identical crises produce radically different outcomes for different positions. The first mechanism to fail, historically, is almost always the currency. This is not accidental. Currency is mechanically vulnerable under fiscal pressure because governments facing resource shortages confront limited options. They can tax, but taxation encounters political resistance and logistical limits. They can confiscate, but seizure destabilizes property rights and risks open revolt. Or they can inflate, debase metallic content, issue beyond absorption, print. Inflation is the path of least immediate resistance. It appropriates without explicit confiscation. It taxes indirectly, and its full consequences take time to become visible. This is why currency debasement recurs with such consistency. In 64 AD, the Roman denarius contained 95% silver. By the 3rd century, that figure had fallen below 5%. The empire didn't collapse instantly. Trade continued. Markets adjusted. But the unit of account had lost its anchor. Wealth could no longer be reliably stored across time in metallic currency. In 1789, revolutionary France introduced the assignat, initially backed by confiscated church lands. Within 7 years, overissuance destroyed its value. By 1796, it was abandoned entirely. France survived. The economy adapted, but the currency had dissolved. The Continental Congress issued currency to finance the American Revolution. By 1781, the phrase "not worth a continental" had entered common language. The revolution succeeded. The nation formed. Economic activity continued. But the currency itself had failed. Here's what standard accounts miss. Society doesn't stop. Production doesn't halt. Markets don't freeze. The currency loses its function as a stable unit. First as a store of value, then as a trusted denominator of exchange. This is the initial fracture, not the collapse itself. Once currency becomes unstable, the second mechanism to break is time-extended financial claims. These are promises that require both duration and denominational stability. Pensions, bonds, insurance contracts, long-term savings, obligations denominated in currency, stretched across years or decades. When currency holds, these instruments function. They transfer resources across time. They allow individuals to save for old age, to hedge risk, to lend with predictable terms. But when the unit of denomination becomes unreliable, time itself becomes hostile. This is the structural trap most people don't see. Weimar Germany between 1921 and 1923. Inflation accelerated to levels that rendered long-term agreements meaningless. A pension that seemed adequate in 1921 purchased a loaf of bread by 1923. Bonds bought with the expectation of stable repayment became worthless as marks lost purchasing power. Insurance policies evaporated. Savings disappeared. Any financial claim requiring stability across time was systematically destroyed, not by deliberate policy, but by the mechanical logic of currency failure. The second break follows from the first. Once money fails, promises denominated in that money fail with it. And here's where the selectivity becomes visible. Those holding financial claims, pensioners, bondholders, savers, suffered catastrophic losses. Those whose wealth was held in productive assets, foreign currency, or tangible goods experienced the same crisis entirely differently. Not different severity, different mechanics. The third mechanism to fail is banking and financial intermediation. But this is where conventional analysis makes a critical mistake. Banks are not the cause of collapse. They are transmission mechanisms. Banks are mechanically fragile by design. They borrow short and lend long. They operate on confidence. They function as long as depositors believe they can withdraw funds and borrowers can service debts in stable currency. When either condition breaks, banks break, not from mismanagement, though that accelerates failure, but because their operational model hinges entirely on stability. This pattern repeats across history. Roman banking networks experienced periodic disruptions tied to currency debasement and fiscal crises. Medieval financial panics followed identical mechanics. Modern hyperinflationary episodes see banking systems collapse as deposit values erode faster than loan portfolios can be repriced. But the failure is selective. Banks with exposure to long-term contracts and failing currencies suffer losses. Those with access to foreign currency, tangible collateral, or short-term liquidity survive or profit. Banks are nodes in a system. When the tiers beneath them fail, currency, then time-extended claims, banks transmit that failure upward. This is mechanical, not moral. So which mechanisms endure longest? The real economy. Productive capacity. Here's the fundamental distinction most analysis overlooks. A financial claim is a promise denominated in currency. Productive capacity is the ability to create goods people require. When currency collapses, financial claims collapse with it. But productive capacity adapts. During Rome's 3rd century monetary crisis, land yielded grain. Farms operated. Trade routes adjusted. The financial architecture was unstable, but the underlying economy remained functional. During the assignat collapse, French farmers continued to grow crops. Markets continued to operate. The currency had failed, but economic life persisted, often through barter or alternative exchange mechanisms. After the continental currency dissolved, American farms and workshops kept producing. The financial system had fractured. The economic system had not. In Weimar, factories operated throughout the hyperinflation. They adjusted prices hourly. Workers received wages multiple times daily so they could spend before values eroded. Chaotic, yes, but production continued. In Zimbabwe between 2007 and 2009, export producers who received payment in foreign currency maintained operations while the domestic currency became unusable. Production persists even when measurement systems collapse. Productive assets retain value because they generate real output, independent of financial instability layered above them. This isn't immunity. Producers face severe disruption, price signals break down, capital formation becomes difficult, networks fragment, but the capacity to produce doesn't vanish simply because currency fails. This tier resists longest because it rests on physical reality, not financial abstraction. But there is one tier deeper still: political continuity. Currency ultimately requires the survival of the institutions that issue it. This is the foundational tier, and it determines whether a system can rebuild or whether it vanishes entirely. Consider the Union greenback versus Confederate currency during the American Civil War. Both were issued by governments under fiscal stress. Both depreciated during the conflict. The Union survived. Its currency stabilized after the war. The Confederacy collapsed. Its currency became worthless paper. The difference wasn't economic, it was political. Governments that survive can rebuild financial systems. They can issue new currency, restructure obligations, restore confidence across years. Governments that disappear take their financial claims into oblivion. This is why the final tier of collapse is political. If the state endures, the financial system can be reconstructed. If the state fails, everything layered above it collapses with finality. Money is a political instrument before it is an economic one. Its value depends not merely on supply and demand, but on the continuity of the authority that issues it and enforces its acceptance. Collapse historically does not mean annihilation. It means reordering. Different tiers fail at different moments. Currency breaks first. Time-extended claims follow. Institutions transmit the shock. Production adapts. Political continuity determines whether reconstruction becomes possible. Understanding this is not prediction. It's not a forecast of future events. It's pattern recognition, an analysis of how financial systems have responded to extreme stress across centuries, across different economies, under different regimes. The purpose isn't to generate fear. Fear is a reaction to uncertainty. The purpose is clarity. Clarity comes from understanding structure. When you understand which tiers of a system are mechanically vulnerable and which are resilient, you stop reacting to headlines. You recognize patterns. You see past immediate crises to the underlying mechanics that determine outcomes. This is not advice. It's not guidance on how to position yourself. It's a framework for thinking about financial systems as tiered architectures that respond to stress in observable, recurring ways. We don't follow the news. We analyze the systems that create it. Not fear, clarity,